Hello, everyone, and thank you for joining us for 7 essential trust accounting reports for law firms, or for lawyers, as part of the Industry Insight series. Our speaker today is Erica Bursler. Erica is the Director of Strategic Communications at Cosmolex, developers of an all-in-one cloud-based legal practice management, billing, and trust accounting system specifically designed for solo and small law firms. Erica's degree is in business administration, and she has over 6 years of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. Erica has given numerous presentations across the country on legal technologies such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. The presentation today will be followed by a Q&A. Please enter your questions into the question box in the webinar panel on the right side of your screen. All questions will be addressed at the end of the presentation. You will also find a handout in the handouts panel that you can download for today's presentation. We are recording this webinar and will be sending the video in a follow-up email in a few days. We will also post the video to our blog at www.lawtechnologytoday.org. Thank you all for joining us. We'll now begin the webinar.
Welcome, everyone. Thank you so much for having me today. So today's topic, as mentioned, is focusing on trust accounting reports. So before we get into the reports themselves, we will talk a little bit about the basics of trust accounting. I'm sure, at least I hope, that those of you in attendance are well aware of the requirements for overall trust accounting. And these will be somewhat a general overview. You know, every state does have some unique requirements and you need to be mindful of those. But this will be a general overview of the compliance to keep in mind. With them, we'll get into those 7 reports. That handout that was mentioned does contain PDF copies of these reports, so make sure to download that before you leave the session today. And then we'll cover some best practices for record keeping, what you need to keep in mind, and how does technology play a role. What's interesting about accounting in general, but also trust accounting, is what you're doing. You may be doing all the right things, but it all comes down to the reports that you're able to provide. If you are being audited or if somebody's inquiring how you're especially handling the trust account, you need to be able to produce documentation to prove what's actually occurring there. And that's what will be covered in the report section today. But if you're using Excel or you have written ledgers, how are you able to even produce these reports? And hopefully by the end of this, you'll have a really good sense as to what you need to make sure is in place in order to pass an audit, for instance. So for law firms overall, in terms of your needs, trust accounting is one portion of that. You do want to make sure that all of your other functions are handled, and some may be higher priorities than others. But I do have to say, the one interesting thing about trust accounting, many people think it's kind of a island to itself that's not really related to other things in the firm, but that's actually not true. It's very much connected to your billing activity, because you might be likely earning money from trust to pay for your fees or reimburse costs. But it's also an accounting activity, because you need to reconcile for those various accounts. You may even have more than one trust account, and you need to be able to report on those and make any adjustments, so on and so forth. So there's actually a strong connection, especially between billing accounting and trust accounting, and everything else kind of factors into your billing, which starts the cycle. So it's important to think of how you're handling those functions right now. Are they communicating with each other well, so that at the end of the day, the reports that I talk about actually make sense? Because the reports are only reflected of the data you put in the system. If you're putting bad data in the system or you're making errors along the way, those reports will either highlight them or be completely inaccurate. So that's one thing you do want to focus on. Now, the next image I find very relatable. We feel like this quite often, just in general, whether it's your personal life, your professional life, things can seem overwhelming, can seem disorganized. But trust accounting is the one area you don't want to feel this way. If right now you're feeling panicked or not knowing who has what money and what check goes to who, and there's a difference of $100 on my account, I have no idea why, you want to get a handle on that. You want to stay on top of that. And it's important to know that no matter who is doing the accounting for your firm, even if you have a bookkeeper or a staff member internally that's handling the trust, let's say reconciliations and reportings and all that, that's fine. But the law firm at the end of the day is responsible for ensuring it's done properly, that you're within the compliance guidelines of your state. I do highly recommend for each of you that you investigate a little bit. Ask your state's ethics board what is required in the case of an audit, so that way you have a checklist. You know what needs to be provided. Today we're kind of doing the same thing, but you do want to make sure there's nothing specific or unique for your state that needs to be provided, and that way you're always prepared. You should be prepared like you're going to be audited tomorrow with all these reports that we talk about already in place, so that you don't feel this way. So now let's talk about kind of the foundation. So trust accounting is a part of legal accounting. It is one of, I like to break it down as 3 different areas of the accounting for your firm. You do need to think about, like, big picture. You have your business accounting, which is your back office. That is you taking care of your payroll and your firm expenses and managing your internal credit cards and your profit and loss and your balance sheet and all of that. You also need to focus on costs that are booked to your client's reimbursement, how your income is being recorded. And then the last piece, which is where trust accounting falls into, is fee advances, retainers, ensuring that the regulations and the guidelines are being followed, because that money is not yet your money. It is your clients that either is due to be dispersed to other parties or to be earned by yourself later down the line. So that takes us to our definition of trust accounting. Fairly straightforward. Bookkeeping of trust accounts in accordance with state requirements. So I'm like, okay, well, that's fairly easy. Trust accounting is actually pretty simple when you think about it. There's money that comes into the account, money that goes out, but you need to keep on top of the tracking. And that's what we'll be kind of referring to today. So simple definition, money that is specifically in an attorney trust account and is being managed within those requirements. So the types of funds that can be in the trust account, you may have a mix of these, you may not, depending on the type of work that you do, but you may have things like settlement funds that need to be dispersed to other parties, whether it's like a class action suit, personal injury, escrow for real estate. Those are prime examples where majority of those funds you're not going to earn. They're going to be going out to other people, but still need to be managed the right way. Unearned income, which are those advances or retainers that you do intend on earning. Some of you may work in an area, let's say like family law, where everything in the trust account will eventually be earned. Or it could be, general practice, where you have a little bit of everything there. And third-party funds is anything that you agree to be the fiduciary for. There may be some situations where you're agreeing to hold funds for a third party, but you're taking on the responsibility of those funds. So only if you're willing to take on that responsibility should you be holding those. The types of funds that do not go into trust is really anything personal, anything related to business expenses like payroll or office supplies like that, unless it's something that you're upfront with your client about seeking reimbursement for. None of those business expenses should be paid for out of the trust account, because that's literally stealing money from your clients. You do want to be aware of each state does allow, or some do, some don't, and the amount varies. Some states allow a buffer, meaning, you as a law firm could put X amount of, usually a couple $100s, if that, in the trust account to cover fees that may occur. Again, some states allow it, some states don't. So you do want to be mindful of that. That's the only, if it's allowed, that's the only kind of business funds that should ever be in the trust account. I also say take a proactive approach. You can't expect your bank to handle your trust funds compliantly. So you want to make sure that when you have the agreement with the bank, when you set up the trust account, you can't assume that they know what to do with that. It's just another service they're providing. That does not mean they're, compliance auditors. You want to ask and see if it's even available. And if so, definitely choose it. That any fees, wire fees, bank fees, anything like that, come out of a connected operating account, not the trust account. Because I'm telling you, those fees coming out of the trust account will cause a lot of issues for compliance, but also just your basic reconciling can get really, really complicated to try to account for those and make sure it's not affecting your client fund balances. So some little tip just to keep in mind, banks are different in how they handle these functions, so you should be asking those questions. And anywhere you're not willing to be that fiduciary trustee, if you're not willing to take on the responsibility for those funds, do not hold it in your trust account. I actually had an interesting conversation just recently with an attorney who was a little nervous about putting a payment link on her website linked to her trust account because she felt, well, anybody can go on my website, anybody can deposit funds in that trust account for me to hold for whatever purpose, even though they're not my client, and then eventually ask for it back. And then I'm then, kind of transferring or handling money for somebody I should not be handling money for. Something to be mindful of. You should not have anything in your account that you're not responsible for. Briefly, I already mentioned that trust accounting is easy. There's really no tax accounting interest unless you have an IOLTA account. If you have IOLTA, even that is fairly simple. It's interest in, interest out. You're not having to worry about the accumulation of that or where that money goes. You don't have to worry about your general reporting. Most of that falls on the business end of things in terms of a profit and loss or balance sheet and all of that. And those bank fees. I already talked about how you want to try to reduce that as much as possible. Ideally, you should not have any of those fees come out of the trust account, but I do understand that not all banks provide that service to take the fees out of a business account, but you should ask that. Now, why is it difficult? So this is where it gets interesting. We talk about how trust is fairly straightforward, money in, money out, but there's mostly, I would say, the tracking or the record keeping is where the important steps come into play. You have to be able to track funds for each matter. And as we get through the reports that we're talking about, you're going to notice all of these come into play over and over again. You have to be able to have a ledger for each and every matter and know what money is there, because many of you might just have one trust account that has, let's say, $300,000 in it. That money belongs to 50 different clients. Well, who has what? If you don't know the answer to that question, that's step one. You need to make sure your records get in order on a matter level. You have to reconcile monthly. Absolutely necessary. Why? Because that's how you find mistakes. And I talk to many law firms that say, oh, I handle the trust account, I do all the work. There are no mistakes. Well, nobody's perfect. I actually say that. Mistakes do happen. You can transpose numbers. You can add a zero by mistake. You can put in a check twice. Those things happen. But also the bank makes mistakes. If they were to withdraw a check amount twice, you could have overdrafted on a client without even realizing it. Or if they did a double deposit and you falsely think that money is there and then it gets taken out, that can cause an issue as well. So you have to do it at least monthly. There are a lot of softwares that do provide, especially accounting softwares that provide feed capability, where you can actually on a daily basis see what cleared and address those daily or weekly. You don't have to wait till the end of the month, because if an error happens on the 2nd, why delay it by 28 to 30 days as opposed to addressing it right then? And then we get into the audit trail. This will be the focus of today's topic, where we talk about the reports that you need to be able to provide and also any sort of physical documentation that you may need. In terms of the tools that you're using, this is typically what most law firms have, one of these three usually for trust accounting. Either you have some sort of manual record like written ledgers, or you're using Excel or some sort of homegrown method of tracking your ledgers. The biggest challenge there is that you love it because it's flexible. You love it because you're able to make it whatever you want to make it. And that's actually the biggest issue with trust accounting. You should not have anything that's flexible. The system and tools you use should actually be very inflexible so that you're not able to do everything that you want, because that's how you get yourself into trouble. That's how you can cut a check when you don't have funds there. That's how you can commingle. That's how you can lose track of things. So something to keep in mind if you are looking to have some sort of software to track this information. There's two routes for that. One is generic accounting software like QuickBooks or something similar to that. Many of you may be using this tool right now. The challenge comes into the fact that trust accounting is very legal specific. So, managing ledgers, preventing overdrafts, preventing commingling, all of those things, the system doesn't even know what to do because it's not working for a law firm in its mind. It's fairly generic for many different businesses. So you can use these tools, but you need to be mindful of what what checks and balances or what precautions you need to take to make sure everything's being done correctly. And the reporting as well. These types of tools are usually fairly flexible with reports. You can kind of build reports that you need, but you need to ensure that you or somebody is versed to build those reports and ensure you can get the right information. Ideally, best situation is legal specialized accounting software. There's a lot of practice management tools that have accounting built in. Cosmos is one of them. Tools like PC Law or Tabs 3 or Abacus. There's many different tools that have legal specific accounting built in. And the benefit of that is you're able to not only have everything in one place, because like I said, your billing, your accounting, and your trust accounting work very closely together, but all of the things you're not supposed to do, it prevents you from doing those. So something else to keep in mind. What tends to go wrong? We're not going to go in depth on this. I think it's just useful, especially if you're, looking at the recording of this later, to understand that you want to ensure from the get-go that you are operating in a compliant manner. Because like I said, the reports that we're going to go over, they reflect the data that you're entering. So you do want to make sure that you're managing those funds properly, you're on top of them, you're reconciling regularly, if possible using some sort of tool that prevents you from doing the things you're not supposed to be doing. All of that needs to be kept in mind. If these are not followed or avoided, I should say, your reports are going to be inaccurate anyway. So with that, now that we have a basis of trust accounting, things to keep in mind, kind of setting yourself up with a very solid foundation to get the right reports that you need. Now let's talk about the reports themselves. So here's a list of 7 trust accounting records. I'll briefly explain each one of them. You do have copies of these in that handout that you can download from the GoToWebinar panel. And then we will kind of briefly go through screenshots and understanding what these reports are. So fairly straightforward. The first 3 are pretty easy. It is a bank journal. Bank journal is basically the activity that happened in a bank account. Now keep in mind that, like I said, most of you probably have one trust account, but some of you may have multiple. If you have multiple, all of these steps need to be done for each bank account, each trust bank account. So the journal is all of my activity that happened in the trust account itself, all of my checks, all of my deposits, really everything. And that gets broken down then into 2 additional reports: receipts, which are all of your deposits, and disbursements, which are all of your checks or your wires or anything that comes out of the trust account. Those are important because when an auditor is to look at your records, if they need to locate a specific deposit or a specific disbursement, they like to have the transactions separated out. Also, if they were to add together the receipts and disbursements, ideally it should equal the bank journal. If it does not, then clearly something is amiss there as well. The 4th report is trust ledger balances. That is the foundation of trust accounting. You need to be able, as I said, to list all of your matters. Let's say you have 300 matters. You should have a balance for each and every one of them. Know exactly what each person has in trust, and each one of those balances should add up to your overall book balance. If it does not, then you're missing something and there's an inaccuracy somewhere. Trust ledger is your individual, what I call a bank statement for your client. So to be able to look at a particular matter and see all of the activity, money in, money out, that resulted in whatever balance they currently have, but that full transactional history. If somebody were to see, or your client may even ask for it, which is quite common, to say, I want to see my trust ledger, I want to see my transaction history, or anything like that. That is what this trust ledger is. Then we get into reconciliation. So you need to have a tool in which you can reconcile. Most of the people I talk to that are using written or Excel methods are actually not reconciling. They're kind of eyeballing the bank balance, it looks about right, and calling it a day. You should be reconciling line by line in your system, every single transaction. If you have a large volume of transactions, like very often in those cases like personal injury or real estate, there are checks going out to many, many different parties. You might have a higher volume. There are tools to automate reconciliation. There are tools to help you find matches. You can import statements, use bank feeds, all of those types of things. So no matter how you do it, you need to make sure you're doing that reconciliation and that you can pull this report. I'll show you when I show you the reports themselves, the difference between a bank reconciliation and the next report, which is a three-way reconciliation. This is specific to trust accounting, also called a trust reconciliation report. The difference is a normal bank reconciliation will have your book balance and your bank balance, call it a day, that's pretty much it. A trust three-way reconciliation also takes into account your ledgers. So if you have those 500 matters, or I'll keep it simple, 50 matters that have money in trust, it will add that up as well, and that should match the book and the bank. So it's that three-way check overall. And I will show you a visual of that. So kind of an overview. Like I said, all of these reports, sample reports, are provided in that handout, but it's important to also ask, like I said at the start, your local audit board, regardless as to what your audit program is. Because for instance, I'm located in New Jersey, we have a random audit, or a random audit state, where they literally will call you up one day at random and say you're going to be audited. Some states, it's only if you have a bank error or only if you have a client dispute. Well, guess what? Your client can have a dispute tomorrow. There are law firms that never get audited once in their lifetime, and then there's some that get audited every couple of years. So you don't want to take that for granted. You want to ensure that you have whatever would be asked of you if you were to get called tomorrow. So these reports, and then, like I said, if there's anything special based on the type of practice that you have or the number of counts that you have, you want to be aware of that as well. So the reports themselves. First one is the bank journal. So like I said, these are samples. I know the sizing might not be ideal. That's why we gave you that handout. But this is activity. You can see I have checks here. I have deposits here. This is for one particular bank account. You notice on the right, the column here, I'll move my cursor over, the column here on the far right is your running balance. A lot of these reports have running balances, and the purpose of that is to easily notice an overdraft. So of course, if you overdraft on your overall bank balance, you definitely overdrafted on your client ledgers. So that will stand out quite easily. This is the receipts journal. So it's taking just the deposit portion of that bank journal and listing those out here. We also have the disbursements journal. This is taking just the check portion of that first report and listing them here. And of course, you can see this is a negative amount because these will all be checks, and the receipts will be all positive. Trust ledger balances. So what's interesting about this report is right now in this sample, I'm only showing 2 matters. So I have a particular trust account, 2 matters, but you notice there is a cleared balance and an uncleared balance because you need to be mindful. There's actually a couple of reports that point this out. What is in transit? What is not yet cleared? Because you are responsible for those funds until they clear. So if you cut a check 3 weeks ago and realize that it's not deposited, and then the following month it's still uncleared, that's your responsibility. You need to follow up with the client, see maybe it got lost in the mail. Very often, if you're cutting a check to an outside vendor, they may hold on to that check and not deposit it. They need to deposit it in order for those funds to be reflected accurately in your bank account. So unclear for a short amount of times, okay, but for long periods of time, that's something for you to address. And then you might even get into the unclaimed funds situation where, you know, they haven't cashed their check. You have this money now in the trust account still. It's been 6 months. They're not responding to you. Then you need to check with your state bar as to what the unclaimed funds process is. That too varies. The amount of time you need to wait, the process you need to follow, but you need to be aware of that because you may end up in that situation. So this points that out so I could see what's cleared and what's uncleared. You notice obviously for these 2 people, I have some items in transit, and I have just the overall balance for those ledgers. Ledger card detail takes, so if I go let me go back one more slide to show you. So these are the balances for those people. So you're basically going to take that balance and drill into the detail of that balance, which is the ledger card detail. So right now I'm on Mr. Brooks's file. I could see for his the trust account that I have funds for him. There were, in this case, 2 transactions. I could see exactly what they are. I could see that running balance, like I said, which is very important. And it also breaks down at the bottom the total credits and debits. Keep in mind that your client could ask for this, an auditor can ask for this, really anyone can ask for this. So you need to be able to produce it fairly easily and not have to, scramble to get this information. The next one is the reconciliation report. So this is the standard reconciliation report. This can be done for any type of bank account, credit card account, business account, trust account, any of the above. You really should be reconciling all of them. The purpose of this is to summarize your reconciliation, what's cleared and what's not. So you see at the very bottom, I'll move my mouse over here. You can see I have uncleared deposits, and right beneath that, I have uncleared payments. That is what you're going to keep an eye on month after month. If something is still there over a long period of time, that's when you need to address and say, figure out what happened to these funds. You're responsible, like I said. An auditor would also look at these, and they might ask for, 2 years of reconciliation reports. And if they see a trend, they're going to be like, well, what's going on with this uncleared item? What have you done? What actions have you taken? So you want to generate that each and every month. I said at the very beginning, and I'll say it again, you don't have to do the accounting. You don't have to be the one doing the trust accounting. It depends based on the resources that you have. But these reports, you can not ask, you can require every month, I need these 7 reports. So that's your way of keeping an eye on the account, making sure everything's being done properly. You can see those uncleared items and inquire what's been done about it. You just want to be in the know, because you're responsible. You will be held responsible if something does go wrong. So that's your standard reconciliation. And then you have the 3-way reconciliation report. This is that specific to trust accounting. So you can see my book balance there is $62.80. My bank balance as well, $62.80. And then you need to add up all of your ledgers. So I have 3 ledgers here. That too equals $62.80. Most of the firms that I talk to either don't know what this report is, which is an issue because auditors require this, either don't know what the report is or is doing this manually. I have 100 ledgers, and every single month I'm adding up manually what they have in those ledgers and comparing it to my reconciliation. Not only is that time consuming, but you run the risk of inaccuracy. What if you're using, you type a wrong number in a calculator, or you add an extra 0, or you count a number twice? That's so easy to do, and that affects your entire important trust reporting. That's what they're looking for. So ensure that, and I could tell you right now, the only type of systems that produce these reports in like one click is legal specific accounting tools that have trust accounting. That is it. QuickBooks doesn't produce this report. Generic accounting software doesn't produce this report. Not to say you can't get, 3 different reports and, comparatively and make sense of it and ensure, as long as they're set up properly, which is the key part, make a check that way. But you need to produce this report no matter what your tool is. In regards to some best practices, you do need to retain these records for up to 7 years. That may be required. Again, you want to be mindful of your state's requirements. Most, I think maybe all, but definitely most bars don't care if it's electronic or if it's printed. So I recommend, because you want to avoid having too much paper all the time, save a PDF of these reports each and every month, store it on your server or your computer, and have it backed up in the cloud or at some sort of external backup. That would be my advice, so that you have these records ongoing. You don't want to run the risk of they ask for 7 years of records and for some reason you can't access your software or you're having problems downloading. Each month, download, have those reports, and archive them. You don't have to print them. Physical copy of instruments. So if they have some sort of question about a transaction, or they say, well, where is this check? What happened with this check? You need to be able to have the proof of the deposit slips that took place, canceled checks, your paper bank statements. You should maintain those. By the way, that's another way you keep on top of your bookkeeper or whoever's handling your books. open up the paper statements yourself. Make sure that somebody, a managing partner or an administrator at the firm, somebody who has that top level oversight can open those statements and make sure nothing fishy is going on, no big issues are happening, in addition to somebody reconciling the accounts. Okay, so that covers the reporting, some best practices. I did want to just include the overall trust accounting workflow so that whatever tool you're using, whatever system you have, you need to ensure that these steps are occurring, because this all factors into your reporting. First is to keep your client funds separate. You need to be able to have individual ledgers for each and every matter. If you don't have that now, you need to take the time to set that up and make sure you do. Also keep in mind that if you have multiple programs, like if you have a program for billing and a program for accounting, you may have your trust records in both. Likely you do, because your retainers are in one and your bank account information is in another. Do they match? They should be identical between the two systems. If they're not, then you need to look into why they are not and ensure that gets rectified. Because if your billing software is not correct, you may think that there's funds there to earn that are not actually available, and that's going to cause big problems for you. You need to be able to, of course, print checks, deposit slips. We recommend printing because not only is it look nicer, it's more professional, but it reduces the risk of errors because you're able to just take whatever you have in your software and put it on a check. Your bank reconciliation, which we discussed, your three-way reconciliation each and every month, your tools have to produce those reports along with the other, 5 or 6 other reports that I mentioned, which falls under that required reporting, and keeping the paper records of those deposit slips, canceled checks, bank statements, all of those things. A lot of bars allow you to scan those items and use those records. If they do allow that, then absolutely take that route. Reduce the amount of paper that you have in your firm, but this entire workflow needs to be managed accurately and as efficiently as possible. So, see how you're doing so far, and if any improvements need to be made, see what is needed to make those improvements. All right, so that wraps up our session today. We mentioned at the very start that I am with Cosmolex. We are a legal practice management software that includes the legal billing, but also the legal business accounting and the trust accounting. So all the reports that we mentioned, all the different functionality was actually produced from Cosmolex. So if you have any questions on those, please feel free to reach out.
And that's all the time we have for today. I'd like to thank our sponsor Cosmolex and all of you for attending our webinar as part of the LTRC Industry Insight Series. And I'd also like to give a special thank you to Erica for presenting today. And Erica, if you have nothing else to add, we will now conclude the webinar.
Thank you for having me. Have a great day, everyone.